Welcome back. Well, taking a look at the other stocks which are buzzing around, take a look at Polycab. That stock has been doing rather well for itself. In fact, it's left behind Havells, and that's the stock which is actually doing much better than the company Havells, which has been the leading wires and cables company. Plus, of course, has Lloyd's and other electrical equipments and FMEG into the basket as well. Let's actually begin our conversation with Deepak Shenoy on just that note. Deepak, what do you make of stocks like Polycab and the other recent listings which we have seen? The pedigree is quite strong, and they've managed to dethrone the erstwhile companies which have been the leaders of the pack. Case in point being Havells.
Absolutely, and we biased because we own some of them in our portfolios. I think though the cable space itself, retail cables, I think has done really well. You've seen a company like KEI also, which got into the space about 3 or 4 years ago, and which is now I think 5x or 6x returns in about 3 or 4 years. We're looking at Polycab. There's Havells of the past, so I think there's been a market share kind of penetration by some of the competitions that Havells has actually not seen so much. Finolex Cables is there; they haven't done quite as much. They were also an established player, but the new ones seem to have come and taken a considerable amount of space. So I think FMEG itself has actually done quite well in the last few years. Some of the brand focus and distribution focus by some of the newer players have actually managed to take market share at the expense of the older players, apart from the market itself expanding. And the market has responded by in terms of having the capex cycle come back. So you're getting a little bit more industrial demand as well, apart from the recovery in retail real estate and so on. So there's a bit of like tailwinds from all directions that seem to be helping them. Though I must say some of these stocks are extremely heavily priced. So you have to be careful when you buy them now.
What do you buy then for those who are still looking at buying a fresh or for that matter adding fresh positions, Deepak?
To be fair, I think Aisha, we don't see opportunities in the value part of the game. Though you might call some of the power finance companies still value because they're not extremely expensive from a price to book perspective or price to earnings perspective. Still have reasonable dividend yields. But their prices are up 200, nearly 200% from the bottom. So rather, they're up 300%. So there's a 3x return from the bottom just this year itself. But still, they're relatively the only value plays remaining in the market. Most of the others, you have to target growth. And I think some of the sectors where there continues to be very strong signs of growth, still remain railways and defense and infrastructure, where I think the current market cap, even though it's increased quite a bit in the last few months, I think we're going to see a significantly higher market cap and in overall industry size, even in semiconductors in the next 10 years. So whatever it is now in semiconductors will be at least 10x or 20x that size in 5 or 10 years. So there is a lot of space for these companies to grow. I would say look at growth as the key point here, not value.
Deepak, I get where your mind space is because my question was actually on FMEG. But yeah, I get power financiers are the story in town. But what about the FMEG space, your KEI, Polycab, Havells, what we were previously discussing? Is that a done story now, or can one still look to buy?
I think honestly, 3 months ago, if you'd asked me, I would have said it's close to being done. It doesn't look like it, honestly. I think in the beginning of a capex cycle, you saw the numbers in that came from GDP. This is the highest manufacturing growth in the last 10 years in terms of just numbers. I think 11% or so. We have seen much higher growth in industry in general, in electricity production in general. We're seeing that overall investment from a capex perspective is back after a long time. If you even reduce retail demand from a residential perspective, I think industrial demand will come back, and FMEG plays a fairly big role over there as well. So I don't think the demand is out yet. The prices may, you could still have increased profits but lower P ratio. I don't expect that to happen in a hurry, but I do think that's a risk that you have to understand, that if you're paying 80 times earnings or 75 times earnings for a company, it could be at 50 times earnings, and the earnings could be higher, and your stock price would exactly be the same. That is the risk you run. But otherwise, I still think there's growth here, so it's worthwhile having a small investment. I would say look at the stronger growing stories. The Havells story, I mean, of growth at least has not returned for a long time. But some of the younger players seem to have growth on their side.
The push and pull of the growth and the multiples that one is willing to pay for that. That's the kind of market we are in. But Sony Patnaik is also joining us to talk to us about the technicals. Sony, some of these stocks are sitting at lifetime high, the likes of Dixon Tech, Hindustan Aeronautics, Bharat Electronics. What would be your recommendation one should do at this point of time? Book profits or continue to hold or maybe even add positions?
Good afternoon, and thank you so much for having me on the show. Definitely, I think we can see all these stocks in very good momentum. You might just think that it's time to book your profits or just like come out of these stocks. But it's just today, even when Nifty is not showing you a lot of movement, these stocks are continuously adding very aggressive long bullish positions. So definitely, there's a lot of space adding up to it. Technically speaking, derivative speaking, especially in Dixon, I can see aggressive long bullish positions, and technically also it is quite poised to take out higher resistances level. So there's no exhaustion just as of yet, and maybe it's better and wise that just you ride the momentum and continue with that. How these stocks are performing, as long as the markets are not showing any signs of correction, I think these stocks will continue to outperform. So there's a lot of heat left in these stocks as of now.
Exhaustion in these names, especially Dixon, but which are the pockets only where you are seeing exhaustion and you would recommend that people should start booking their profits?
I think it would be pharma space, looking at the entire data, although it has performed well in the past few months, maybe it is losing a lot of the momentum as of now. I think there are other sectors which are coming out, and pharma is, just like lagging behind. So it would be better and wise to book out the profits from the pharma space. PSU banks, maybe like, partial, somebody can actually book out profits because switch happening from PSU banks to private banks. And in the coming trading days, it looks like the private sector can just outperform the PSU banks. So these are two of the spaces where one must book your profits. Power sector, we feel that there's still more upside left, so there's a heat. I think it's just out of these two sectors, the rest of the sectors still look fine, and any dip you would definitely get a chance to enter, and these sectors will continue to outperform.
Deepak, since you alluded to infrastructure as a space, I'm automatically thinking GMR because there's almost a re-rating of sorts ever since GQG picked up that stake in the airports business. Are any of the group names something that you would take a look at?
So I think GMR has gone up because of infra, at least has gone up because I think of the airports, of the stake that's been picked up. Some of these, and GMR has history that does not, has these problems of extremely complex corporate governance issues that tend to happen in certain companies. Earlier, it used to be because they were either politically aligned or otherwise having political compulsions. Nowadays, it's because cash flows are not managed very efficiently. And I think GMR, unfortunately, has been one of those stories where cash flow management has not been all that great in the past. And therefore, I would probably choose some of the other players who seem to be able to manage some of these things better, including the smaller but more focused players like of KNR Constructions on roads, or some of the players around in the railway space, both manufacturers and providers. Even a BML, though prices, that's a PSU company. I think infrastructure by itself, while it has typically meant roads and bridges and things like that, now I consider a lot of things infrastructure because you have roads, rails, ship, and a lot of government-based contracts driving value into these areas. I would look at companies that are able to manage their cash flows better, and even a company like Mazgaon Dock has amazing cash flow management for what is otherwise a government company. You find that they have net cash on their balance sheet because they get paid in advance. So some of those aspects matter more. I think GMR is not our top pick if it comes to the sector here.
Okay, point taken. So that's the latest coming in on the infrastructure space. We'll try and get you the bite of the management of Mazgaon Dock because they spoke with us exclusively today. But in the meantime, Naresh, let me, get your view on a couple of these big buzzers for the year. And I would request to fire the YTD chart of BSE. That stock is up 333%, and ditto can be said for Titagarh Wagons as well, almost 4x, 5x this year itself. What is your recommendation on these two names, Naresh?
So it's a simple recommendation, hold, because the momentum is pretty strong. Cannot buy at these prices because the risk reward is way out of line. And most of these names have, both these names have had a very sustainable move wherein they've kept on making some dips and continued. So it's not a circuit to circuit move as such. So the momentum is positive. It's a hold at current levels, or one can keep a trailing stop loss, which would be a little more deeper than 15-20%. So that's a tough ask, but not a buy at current levels.
In fact, we chatted with the management of Mazgaon Dock earlier today, and not just they're extremely confident on how the shipbuilding as well as submarine business is going to actually pan out, but they were extremely enthused about the offshore drilling equipments as well, and the recent order of 1145 crore rupees that they bagged from ONGC, saying that eventually they do see in a 3-year time frame about almost 5,000 crore rupees worth of orders from just the offshore segment of the business. Here are what the management said.
With this first order from ONGC, we can say we are back into it, in addition to what we build in terms of ships and submarines. So this is about 1145 crores business, and we are looking forward to having about, say, 5,000 crores per year in times to come. That is the minimum we are targeting. Only because we are just beginning, though sky is the limit, we are looking at a small pie out of this $11 billion dollars market to start off and go up to 5,000 crores to begin with. In about, say, 3 years' time, we hope to touch that target. This is a 6 months order. We have to complete the order in 6 months, this particular order. And there are more orders in the pipeline.
So that's the latest commentary coming in from Mazgaon Dock. But actually, let me take it across to my colleague Sameer as well, because that was the exclusive story that we are picking up on sugar sector. The stocks have been doing a lot of volatile moves. There has been a lot of flip-flop. What will happen in terms of the diversion of sugarcane juice for, the entire ethanol preparation or not? So let's go across to Sameer to get what the latest is, and then we'll ask Deepak as well what his view is, how one should tackle these news flows. But first, Sameer, tell us what's the latest?
Government's big and bold move disallowing the sugar mills and distilleries to use sugarcane syrup and juice for making ethanol has brought in a bit of setback to the sugar industry, and that is the reason that now the industry or the important stakeholders, they are looking to get a better clarity in terms of policy roadmap from the government's top head. What we are getting to know from our sources that the sugar industry is likely to meet the PMO officials Tuesday evening, and this meeting will be more on to understand that what is going to be the policy roadmap, and if this decision is a temporary pause, then how the government will move forward. If the crop yield improves, then what is going to be the government's step. So on this important aspect, this important meeting between the PMO officials and the sugar industry on the issue of ethanol is likely to take place on Tuesday, December 12th. But we are also picking up from the sources that food ministry officials, they have maintained a stand that this decision is a temporary pause. This is going to be reviewed periodically. In a month, this decision will be reviewed, and based on the situation, based on the crop yield, based on the estimate of sugarcane production, the decision might be reviewed and then a corrective step might be taken. But as of now, sugar industry is looking to get a better clarity in terms of policy roadmap. They are going to meet the PMO officials Tuesday, December 12th.
Okay, a lot of flip-flop really happening on the entire sugar story. Hopefully something should come up tomorrow, given that there's a meeting lined up with PMO. So maybe something conclusive comes out of there. But Deepak, on this entire renewable energy play, and I know you've been adding to your portfolio around this theme, any new additions that you may have made or stories that you're looking at?
No, well, actually, we know that IREDA is just listed, so we're going to wait a little bit before we typically would wait for a quarter or 2 quarters of results before we consider adding something here. But we're doing a lot of little bit more downstream, so in the sense of not the power producers themselves, but maybe some ancillaries in the space. There's a company we've been buying it for a now. So it's called KSP Pumps. They've got some orders to produce pumps for new nuclear plants that will be coming. So they're one of the few people who can do this. Of course, they're an MNC. But apart from that, there's a lot of other providers. But we haven't yet gone down the route of going directly to say a companies like Suzlon or something like that, where there's a history that prevents us from just directly jumping into a position, but also the fact that we haven't yet seen the numbers show out in some of those spaces. Renewables itself, while I think the sugar industry is more towards the ethanol and therefore cutting crude effective consumption by about 15-20%. The idea, I think, on renewable is that India is a relatively better source. So companies like NHPC, IREDA on the financing end, and a couple of other firms will do well in the longer term. I personally would like to bet on the people providing the pickaxes here for people to build more power facilities rather than those operating those power facilities. So we're trying to get more into that space. I'm sorry, I don't have too many names right now that I can talk about. We're still buying a few, but I think this is still early days. Anything that requires that is, we call it energy substitution, and I think that substitutes crude in the next 10 years will be a huge thing for India, and I think many of those companies will go 5x 10x from here.
In the next few years, energy transition is the theme to bet on if you're looking at the next decade. But what about the next few minutes and next few trading sessions? Let's try and decode that with Naresh as well. Naresh, a big spike on tube investments, higher by 12%, and then some of these public sector banking names continue to trend higher. Top bets from that vertical?
So, tube investors is something which keeps seeing this spiky moves ever since the semiconductor announcement they've made a few weeks back. So, no views out here at current levels. But in terms of PSU banks, I would go with the State Bank of India first, and then the whole basket of small names, because State Bank of India has gone nowhere for the last year or so, and is now testing that 600 to 625 mark, which has been a major resistance for the stock. So that is one which could go and break out. And next would be a Bank of Baroda, which has again come very close to the previous 52-week highs and also all-time highs of 225 to 230. So the stock was last at 220 odd levels back in 2010 to 2014. So Bank of Baroda could be the next one, which looks pretty promising in the PSU banking space.
Okay, point taken. So that's the next bet to watch out for in the PSU banking space, Bank of Baroda. What about the entire insurance sector? Seems like that is also in for a bit of an overhaul, and I'm sure Deepak will be interested in this one, given his bets in LIC, but I'm sure he has bets in other health insurance names as well. Let's first go across to my colleague Anurag to try and understand what the news flow is, and then we'll deep dive into it further, because the entire news flow seems to be around interoperability, how the entire hospitals might be needed to admit the cashless system and processes despite you not having the insurance with the accredited agencies of that particular hospital. Let me take it across to Anurag to get more details. Hi Anurag.
From January 2024, cashless treatment can be availed even in non-empaneled hospitals also. So this will be the arrangement before the implementation of common empanelment. And as mentioned by the IRDA, insurance regulator IRDA want to achieve the target of 100% cashless claim. Presently, and the cashless claim ratio is 53% only, and IRDA has set a target of 100% cashless claims. So before the new arrangement has been made among the insurer, in which if a policy holder goes to a hospital which is not empaneled on that insurance company, then on the basis of rates of other empaneled insurers, policy holder or patient can avail the cashless treatment. And that will be mainly for the planned treatment. So 48 hours prior to the treatment, insurance company will agree to the policy holder, okay, you can go to that particular hospital, and they will have the cashless treatment on the basis of other insurance company. So this arrangement will lead toward the full cashless claim and reduce the overcharging by the hospitals, and insurers are also are going to accept the common claim acceptance rate on the basis of hospitals based on their location before the implementation of common empanelment, which is likely to happen in coming time.
Right. Deepak, curious to know where within the entire insurance space are you invested, or think there is an opportunity?
So actually, we are only invested in LIC at this point. Upstream, of course, we own some banks, which therefore own a stake in their health insurance or life insurance companies, but primarily LIC right now. I think this kind of an announcement is useful for consumers. It will have to be seen about how this impacts certain insurers who have unempaneled certain hospitals simply because there's too much fraud, or there are lots of claims which cannot be verified, and therefore they unempanel those. That's the problem in health insurances in India. There is a significant amount of fraud, and not most of it just there are no repercussions for fraud in this case. So very few can actually be proved. So what insurers do is empanel only relatively trustworthy setups. But if there is a national insurance network that has to be cashless, then we have to find out how the fraud reporting or checking can actually be addressed meaningfully. We'll have to see how that pans out. But if that does come, then I think it will be a benefit for all health insurers in the country and for all consumers as well. Longer term, the industry will only grow.
Also, it becomes too commoditized, right? There is hardly any differentiation then in terms of what you're going for, apart from, of course, claims ratio and a lot of other service issues. But, on that note, Deepak, we let you go. Appreciate you joining us today. Time to also take BTSC ideas from our technical experts. Sony, what's the BTSC trade that you are spotting?
So BTST would be Jindal Steel. We've seen very aggressive 8% long built-up positions today. And, it's giving the breakout above 720 plus levels. So Jindal Steel is a good buy from current levels for targets of 760, 750, 760. And you can keep a stop loss of 695.
What's the BTSC trade?
So first would be a buy on Info Edge Naukri, which is close to a breakout, stop loss at 48.50, target price of 5,000. Second is a buy on Mahanagar Gas Limited in a new 52-week high and all-time high here, stop loss at 11.70, target price of 12.20.